Hi, it's Kira. Welcome back to Economic Simplicity. Today, we're going to be discussing the topic of the S&P 500. The S&P 500 is one of the most followed stock market indexes in the world. By the end of this video, you'll understand what that is, how it's calculated, and its importance in the financial world. So let's get started. The S&P 500, or Standard & Poor's 500, is a stock market index that tracks the performance of 500 of the largest companies listed on stock exchanges in the United States. Created by the financial services firm Standard & Poor's in 1957, it serves as a broad benchmark for the overall U.S. stock market and economy. The S&P 500 provides investors with a snapshot of the overall market health. It's designed to measure the stock performance of the large cap segment of the U.S. market, offering an excellent gauge of the broader economy's well-being. The S&P 500 was introduced as a way to provide a more comprehensive view of the market compared to the Dow Jones Industrial Average, which tracks only 30 stocks. Since its inception, it has become one of the most widely used indices by investors and financial professionals alike. Unlike the Dow Jones Industrial Average, which is price-weighted, the S&P 500 is market capitalization weighted. The market capitalization, market cap, of a company is calculated by multiplying its stock price by its total number of outstanding shares. For example, if a company has a stock price of $100 and 1 million shares, its market cap is $100 million. In the S&P 500, companies with larger market caps have a more significant influence on the index's movement. This way, the performance of larger companies that make up a substantial portion of the U.S. economy has a greater impact on the index than smaller companies. Think of the S&P 500 as a weighted average where bigger and more valuable companies pull more weight. If a giant company like Apple has a good day, it will raise the index more than a smaller company would. The S&P 500 includes 500 companies from various sectors of the economy, making it a well-diversified benchmark. The sectors include information technology, healthcare, financials, consumer discretionary, industrials, and many more. To be eligible for the S&P 500, a company must meet specific criteria. Market capitalization. The company must have a market cap of at least $8.2 billion. Liquidity. The stock must have a high trading volume. Domicile. The company must be based in the United States. Public float. A substantial portion of the shares must be available for public trading. The components of the S&P 500 are reviewed regularly. Companies can be added or removed based on their ability to meet the criteria. This dynamic nature helps the index remain an accurate reflection of the market. The S&P 500 is often used as a proxy for the overall market performance. Here's why it's so significant. Broad representation. With 500 companies across various sectors, the S&P 500 offers a comprehensive view of the U.S. economy. Investor sentiment. The S&P 500 is considered a barometer of investor sentiment and economic health. A rising S&P 500 suggests confidence in the economy, while a falling index may indicate economic trouble. Performance benchmark. Many mutual funds, pension funds, and index funds use the S&P 500 as a benchmark against which their performance is measured. Index funds and ETFs. Many investors choose to invest in index funds and ETFs that replicate the S&P 500. These investment vehicles provide exposure to a broad market segment with the benefits of diversification and lower risk compared to individual stock investments. Portfolio diversification. Including S&P 500-based assets in an investment portfolio can help diversify risk, given the index's broad nature. Historically, the S&P 500 has delivered an average annual return of about 10%, making it an attractive long-term investment option. However, it's essential to note that past performance is not indicative of future results. While the S&P 500 is widely respected, it has its share of criticisms. 1. Large cap focus. The index heavily weights large cap stocks, potentially overlooking the performance of mid-cap and small-cap stocks. 2. Sector concentration. Certain sectors, like information technology, have a higher representation. This might skew the index overall performance. 3. Changes in composition. Frequent changes in the index composition can lead to higher transaction costs for index funds replicating it. In summary, the S&P 500 is a crucial tool in the world of investing, providing a broad and reliable gauge of the U.S. stock market and economy. Its market capitalization weighted approach ensures that the performance of larger companies has a more significant influence on the index, reflecting the health of the overall economy accurately. Thank you for joining me today on Economic Simplicity. I hope this video has clarified what the S&P 500 is and why it matters. What financial concept would you like to see broken down and animated? Let me know in the comments.